WGNradio.com. There's a bunch of buttons there for you to press for the red kettle. You can also vote on who's on the naughty or nice list for hosts. John and I are currently tied at 83% nice, 17% naughty, although Lou Manfredini's ahead of us on the nice list. Just mentioning that me and John are tied because not to put Craig Bolanos on the spot, he's the co-founder and wealth advisor at VestGen Wealth Partners, GetRetiredStayRetired.com. But Craig, me or John Williams, who you putting on the nicer list?
I will always choose John to be on the nice list.
You'll choose whichever show you're on, Craig.
I don't know. Oh, listen, I love you both. I love you both equally. You guys are equally tough on me. I mean, I don't get any copy of what we're going to talk about before we go live. So bring me into the discussion.
That's how we like to do it.
Mind?
Yeah, for sure. Well, a lot is on my mind, Craig, and it starts with, we're starting to get some of the delayed data, the jobs reports, the retail sales numbers. Is anything worrying you, or is it maybe the idea that there was this big economic downturn in October that wasn't going to be told to us was overblown?
Yeah, I think two pieces. One, on the jobs report, I mean, that disastrous October with all the job losses, that was everybody rolling off what I call the severance packages courtesy of DOGE earlier this year. So I think that was to be expressed. With that headline number, no, that headline number of 4.6, it's not good for anybody. I certainly thought we'd be at least at 4.5. I said that on your show a couple of times. I think it proves the thesis correct. But I think people are still missing the bigger picture here, and the bigger picture is the renewal of the Tax Cut and Jobs Act, which is OBA, the changes to some of the underlying inflation data we're going to be seeing year over year on shelter, the fact that AI enthusiasm remains, even though AI infrastructure enthusiasm is being tested this week, as what you saw from Oracle. This is a prescription where the S&P can and likely will grind higher into 2026.
And then beyond that, it's anyone's guess. I've started reading 1929. I don't know if you read it, Craig, and I'm only a couple chapters in, but I know how it ends, and not so well. And I'm not suggesting we're there. There's a lot of things that are different. Although in 1929, they were all saying, well, this is nothing like the panic of 1907. We'll never get there. There is a little hubris that is, I don't know if you feel happening right now in that, yes, we had a correction in 2022 or a bear market for a bit, but boy, what a snapback. Same thing during the pandemic. I mean, really, we've been rolling now for like 12 years, Craig. It cannot possibly go like that forever.
No, I recognize the four most dangerous words in investing is this time it's different. This time it's different. Somehow rationalizing that the past isn't going to repeat itself in the current. So I think we're eventually heading to that. I think we're eventually heading to a market melt up. But again, bull markets die. They die with irrational exuberance and intoxicating enthusiasm. We haven't had any of those. I mean, John, how many people have completely sat out this rally in 23, 24, and 25 because they all jumped onto Recession Island? I don't think anyone's on Recession Island, but there's just so many people who do not believe, even though it's the season of believing.
So you would say that even if there's enough people that have sat on the sidelines, and you obviously have talked to people that have or didn't feel good about it, that can temper a big run, an inflationary run that is beyond the means of what is really there.
Yeah, I mean, John, the truth is at VestGen Wealth Partners, we serve clients all across the country. Me personally, I visit with people in 41 separate states, and we don't have people screaming and clamoring to say, buy me more stock, buy me more stock. More oftentimes, people are more worried about risk reduction strategies at this stage in the market. And I think that's responsible for people who have already gotten retired and want to stay retired. But it is also so different than the resounding enthusiasm we saw during the dot-com bubble, the resounding enthusiasm we had leading up to the great financial crisis. And that's what makes me say we are not there yet.
Yeah. I listened to you, it must have been Friday with John, and I really appreciated your chat about like Bitcoin, and John was asking you what percentage should be Bitcoin. And, I personally have done a little bit, and this is not advice or anything, but I don't like the whole digital. I just did a couple of the ETFs when they came out because it was kind of fun to see how it all worked and everything, and just kind of did that. But I do appreciate that people should be, and your clients, and you're probably chatting with them, finding areas where maybe there is opportunity to make it or hedge it, right? Hedge some of these things that we've seen other places.
Well, I think, John, you and I have even talked on your show. I give you credit. We've talked about the K-shaped recovery. We've talked about the impact of artificial intelligence. And I think an investment theme for everybody is what can I invest in that artificial intelligence isn't going to replace? And what can I invest in that artificial intelligence isn't going to reprice? And that leads to a discussion of those assets that have scarcity, whether it be precious metals, certain versions of cryptocurrency like Bitcoin, which is finite once it's done being mined. It also leads you into discussions over things like energy and real estate. I think all of those are undeniable trends that at least deserve a discussion prior to implementation for investors.
Yeah. I think you just bring up such a great point that it's not only about diversifying within the S&P 500 or your stocks, it's about diversifying what you own, right? I mean, just generally speaking, finding completely different areas so that when there is that meltdown or whatever it ends up being, that you have some protection in certain places. I imagine people can give you a call, can reach out at getretiredstayretired.com to further that conversation. I'm glad people are having it though, Craig.
Yeah, no, I think it's just key. I think, be diversified with purpose. And again, that's not just stocks and bonds. There's a reason private markets and alternative investments are out there. And I think people should get empowered with education so they can link those to their financial plans and make good choices as we go further into this market cycle.
All right, Craig, I don't know if we're going to chat before the new year. Probably not. Have a great holiday season, and we'll chat in January. Okay, buddy?
You too, John. All right, go Hawks.